So now we have a very interesting panel, which at IVCA we are proud of from a perspective that this is one of the focus areas on which we work. This year's budget actually marked a paradigm shift in the way the government or the regulator perceives private capital, private equity, venture capital, and startup, this industry specifically, and our contributions to how we can, enable growth in startups, mature companies in the nation. So we have in this panel, esteemed folks from various funds share their perspectives on the expert committee, which was announced in budget 22-23, and whether it marks a paradigm shift, what could be the scope of the committee, what could be the objectives and constituents of the committee, and how this will or probably can change the way private equity VC ecosystem grows in this country and enables growth. So for sharing their perspectives, we have in the panel Mr. Ashley Menezes, who's the CEO and partner at Chris Capital Advisors LLP. We also have Mr. Gopal Srinivasan, Chief Managing Director, TVS Capital Funds and Senior Board Member IVCA. We also have Mr. Rehan Yar Khan, Managing Partner, Orios Venture Partners. We have Mr. Siddharth Pai, Founding Partner and CFO, 314 Capital. And to moderate the panel, we have Mr. Karthik Reddy. He's the Vice Chairman at IVCA and co-founder and Managing Partner, Bloom Ventures. Can we have the panelists and the moderators on the stage, please, now?
Thanks, Rohan.
Thank you. Welcome to you.
Introducing the panelists for me.
I'm not needed on the stage, Jimit, so continue.
Great, we're all set. Thanks, Rohan, again, for handing over the stage. Very warm welcome to you folks who've been listening in all afternoon to exciting panels, the IVCA Annual Conclave. I have with me an esteemed panel which doesn't require too much of an introduction. They've been at the helm of pushing the industry's, requests, demands, whatever you want to call it, with various aspects of the government machinery over the decade. I have Siddharth Pai, Gopal Srinivasan, Ashley Menezes, and Rehan Yar Khan. They've all been instrumental in various expert committees that we have set up over the years as a part of IVCA. And they have been, as I said, driving the Regulatory Affairs Committee. So in that context, I wanted to launch this panel, which is called Expert Committee, a paradigm shift in the PEVC ecosystem. So as a lot of you know, the government finally acceded to the industry's demands in the budget this year, where the Honorable Finance Minister launched the idea of this expert committee. It was mooted by the industry for a long time, and folks like Gopal had to make multiple visits to various parts of Delhi to ensure that we get our audience with various members of the government, and only then will we be able to solve for all of the industry's outstanding issues at one shot rather than piecemeal. And the background and the framework for this is, as a lot of you know, the 40 billion, 60 billion, if you add, depending on what you count into last year's investment in PEVC into this country, we've become as an industry a sort of a moving force for development of the infrastructure in this country, digitally or otherwise. And the idea is to push this even further. So if we want to hit our sort of $5 trillion GDP target, we're looking at potentially, or even further after that, a $10 trillion target over the next 20, 25 years. That should be a sort of a noble goal for India at 100. And the clock has started ticking. We are in the post-75 year birthday celebrations of India. And I think to get there, the quantum of capital that we're talking about from 5 trillion rupees has to get to 25 trillion rupees. And lo and behold, a lot of that is going to come from the members of the IVCA and each of our efforts, and hopefully many, many more fund managers who come down the line. And I think, how do we frictionlessly scale? So the overarching punchline that the industry has made in forum after forum is that the friction that is there on the inbound in terms of investing, and the friction that is there on the outbound as you exit the companies, whether it's through M&A or public markets, etc. The more you remove that friction, the more the velocity of this capital increases into this economy. So on that note, and maybe get first reactions from each of my guests, the panelists, on what they view is the sort of holy grail of this expert committee. And who better to kick that off than Gopal? And then we can just go sequentially from Gopal to Siddharth to Ashley to Rehan, as I see them on the screen. So please go ahead, Gopal.
Thank you, Karthik. I think this is an industry that definitely has been born in the womb of government regulation. If you go back in the last 8 years, series of regulatory changes, whether it's for foreign capital, foreign fund managers, Indian fund managers, have happened. Now the question is, there's a lot more that can happen, Karthik, to meet the aspirational goal of 25 trillion rupees invested each year. And maybe our AUM is going, there is a non-mark-to-market AUM going from 12 trillion as per venture intelligence to 100 trillion. So a huge journey in front of us, and we need now more tailwind is what we're saying. I just want to leave only with one thought. 32 years ago, when Michael Porter wrote his famous book on the competition of nations, right? He said national prosperity is created, it's not inherited. And it is a child of various things, including national values, national culture, national economic policy, economic structures, and institutions. So I really think we are at a position right now where, especially in the light of this very unfortunate war that is going on also, which accentuates the fact that India's national competitiveness is what this conversation is about. It's not about a frictionless scaling of the industry, but it's how do we convert the talent in this industry to support our great entrepreneurs, with the government actually thinking of regulation as a competitive advantage for the nation rather than doing any industry a favor by removal of friction. I think we're poised at that point is all I have to say.
I'll come back to you very soon, Gopal. I want to track every one of our journeys over the last 25 years as well. It's very telling, the point that you made about how government has been an enabler. And I would want each of you to contextualize it in your journeys, but we'll come to that later. So opening again, Siddharth, given the topic headline, what does the expert committee mean to you? Yeah.
Thanks, Karthik. I think, one of the greatest issues or the friction points when it comes to regulation that actually affects the PE, VC industry as of now is that the entire industry has actually been sort of force-fitted into the existing regulatory frameworks as part of it. So there's a large amount of legacy issues that have actually existed from like the 1800s and the 1900s in terms of some of the regulations that actually apply to the private equity and venture capital industry that have actually ended up hampering the industry to a very, very large extent. So one of the things that the expert committee, I'm hopeful, actually looks at is to actually create an entirely new set of regulations and a new framework rather than actually force-fitting us into the existing system in itself, because that in turn is actually leading to friction. It's actually leading to a large amount of litigation, and that leads to uncertainty. And the greatest anathema to capital is actually uncertainty. And the moment that uncertainty actually goes away, and the uncertainty caused by regulations, the easiest uncertainty to actually mitigate away, then the entire industry can actually not just go to 25 trillion, but even to 100 trillion and even to far larger figures as part of that.
Thanks, sir. Ashley?
So, I mean, I completely echo some of the points that Siddharth made, right? I'm reminded of this line in Gurcharan Das's book written about 20 years ago, where he says that India grows at night. Now, that was a direct reference to the BPO industry, but it was also a veiled reference to the fact that, despite there being regulations, as opposed to in spite of regulations, you're seeing India growing. So India is growing despite the regulations. And so that is the point that Sid's made as well, right? Which is in my mind, the private equity industry has grown over the last 20, 25 years significantly and has contributed to the overall economy of the country. But it is one aspect to reach till where we are today. I think to go to the next step, which is a quadrupling or multiplying by 5-10 times from where we are today over the next 5-10 years, as you've as you pointed out, Karthik, there needs to be a sea change, right? And I think that is what we would want this thought process. I think this hopefully the induction of this new committee will wear a hat of looking at things de novo, not try to work on existing systems and just work with a fresh canvas to see what needs to get done. I think that is the important thing. Today we are dependent on foreign capital. How do you make India self-dependent on domestic capital from a longer-term perspective? What are the issues that have been facing investors as to why people have been coming in through multiple routes, whether it's AIS, whether it's the former FDCI structure, whether it is FPIs in some cases, FDIs in some cases. So why do we have so many regulations? I think there needs to be a clarity of thought in terms of how we go ahead and we pave the journey for the next 10, 15 years.
Rehan, would love to hear your views.
Thank you. Echo very similar views to what Gopal said and Ashley said. Gopal said it very well when he said that this is an opportunity to create the competitiveness of nations. I think regulation to date has always been looked upon as a way to protect certain segments of the population, right? Investors, small investors, etc. in the case of funds. But I think that now there's an opportunity to lay out a strategic roadmap, a strategic vision for what investment can do to India, right? How in that goal of that $5 trillion economy, $10 trillion economy, what is the role it will play? What are the strategic objectives? What percentage of that should be domestic capital? What percentage of it should be international capital from various sources? Which are the industries? Which are the focus industries that should grow? I think this is an opportunity to lay out that strategic roadmap, because as we know, investment is at the heart of growth, right? This $5 trillion economy or $10 trillion economy is at the end of the day going to be powered by investment. It is finance that creates this growth. So I think this is a golden opportunity to do that. And we are very excited that this committee has come about, because, till now what was happening was ad hoc, plaster fixing here and there. You made a representation to a minister. In their busy schedule, that minister heard you and said, okay, I'll get this kind of thing done. But there was no sort of overall master plan. So I'm very excited that, this is an opportunity to create that master plan for us and for this wonderful nation of ours.
I hope the four speakers for the audience, you've gotten a good handle of why this simple term called expert committee was championed for this long, and why it's become materially very important for the industry to look forward and plan the 25-year journey to India at 100. And more importantly, even think through short term. I mean, all of us may or may not be in the industry at that point, but we, like what we did over the last 10, 12 years, 15 years, is pass on the torch to folks at the end of this decade and hand it over with an incredibly sort of, well-oiled, frictionless sort of ecosystem for all the objectives that my panelists very eloquently laid out. Now, what I'd like to do is maybe chart journeys a little bit chronologically. So interestingly here, I think that would be Ashley, Gopal, and then Siddharth and Rehan. So Chris Capital started in '99, TVS Capital in like 2007, and then I know 314 and Orias are a little like Bloom, the post-2010 babies in the, relatively speaking, in the ecosystem. Would love to hear the positive side of this. So despite all these challenges, the industry has mushroomed, right? So if you look at each one of our first funds, right, we're probably at a scale of anywhere between 5 to 10x of that size today. So clearly we've miraculously made something work as an industry. What is helped along this way? And maybe, 2-3 things that Ashley, you recall from this 20+ year journey on what the government has, done to actually accelerate the venture capital PE industry. Can set a framework for the rest of the conversations going to the second part of this panel as well. Go ahead.
Yeah. Thanks, Karthik. So I think, clearly evolution of the industry and firms in that industry has been partially due to the favorable ecosystem, and obviously there is some aspect related to how the funds themselves are performed. Given that this panel is touching upon the former, I think, look, when we started investing in 99, 2000, there was a clear sense that you wanted to partake or look at investing in businesses or companies that had minimum touch points from a regulations perspective. And that was because there was the overarching belief that, look, it's a little more complicated. We are not clear as to what may happen, and we've seen that. We've seen that, people who invested early in telecom did very, very well, and then, as you saw the licensing, etc., come out over time, you've seen some businesses fold up or sort of being forced to merge, and they've gone through their own life cycle. On the other hand, you've also seen things, when we first started investing, almost every industry required, given it was foreign capital investing, required a DRPP approval. Today, that concept is unheard of. So I think, overall, I would say, I think that the industry has evolved because I think the government and the regulators have been having a conversation with the stakeholders and understanding what are the pain points. And as I think as Rehan said as well, what we have been doing is working on a piecemeal system, saying, look, this is an issue, how do you deal with it? You've seen strengthening of regulations in some cases. SEBI has become much more active than it was 22 years ago. But you're also seeing flexibility in people and the government understanding the real purpose behind investing. So I think there needs to be a balance. As a regulator, the role of the regulator is to ensure that there is no abuse of policies. So there needs to be an overarching policy, and then there needs to be a systemic monitoring or discipline. Some of it comes through self-regulation, some of it comes through overt regulation. I think we as an industry need to also be disciplined in our way of not abusing those things. So today, when there are and there are situations where we as investors would want to get a little cute in terms of things, how they structure, etc. So that when you do things like that, what we realized over the long term is that at some point it catches up with you. So you may have 2-3 years of a good run, but over time, the regulations will be tweaked because that was not the intent. So I think it's important, at least the biggest learning that we've had is, look at the substance versus the form, and work on those lines. I think overall, I would say, there has been a myriad of regulations over time. And as I said earlier, I think the hope is that it gets simplified, right? I mean, there was a conversation I was reading about, the Income Tax Act was changed, I think first written in the 1880s or something, and then 1961, and so it's due a change now. It's 70 years again, or 75 years, as opposed to the income tax regulation going through, yearly amendments, and then there's another clause and another clause, and then a proviso to that clause and a proviso to the proviso. It needs to be, you need a clean slate in some of these things, and to say, look, how can I simplify regulations as opposed to making people very dependent on advisors because of the complexity of regulations.
Thanks, Ashley. Gopal, any different views?
I just love what Ashley
to add
said.
From the,
What I just love what Ashley said is that India is like a piece of bad programming code, right? That's income tax like that. No, I was just thinking, Karthik, we talked about first competitiveness of nations, and this is a competitive part of India's architecture. Ashley beautifully brought out the need, and I think so did Rehan and Sid with their comments about the need for a coherent framework, which will basically cohesively hold together everything rather than, made for fit for purpose kind of framework rather than adapted from other like Legos. I just want to talk about only one idea, and that is confidence, the third C, right? Yeah. Why am I, as an individual, as an Indian, as a BCP player, confident, right? I'm sitting here in 2022, managing close to $300 million of Indian money. This is something I could never have imagined, and only Indian money, right? Don't have a dollar. And I could never have imagined this in 2007-8. It seemed like silly, right? When somebody said there are 2,000 crores of Indian money, right? So the fact is, it's real. It's become real. And you guys and Ashley and all have really shown the way. And I think everybody, Bloom, 314, Orias is doing their own innovative things. The reason I have confidence is that two things, right? One is I look at what happened in SEBI's IPAC. SEBI's IPAC, the first report there was a clause which we quoted now instead of going 32 years ago, I'm going 16 years ago to C.K. Prahalad when he spoke on India at 75. He said we should start the next practice, not just follow the global best practice, right? SEBI's IPAC actually did that, whether we like all of it or not. For example, performance benchmarking, NISM training material, right? More specifying what level of disclosure they want to see, and on and on and on. So we are able to do the next practice in regulation as much as we're able to do the Aadhaar and UPI. That's what gives me the confidence. So when I look at what is going to happen in IBC, when I saw IBC, 42 changes in law. Yeah. One whole law was repealed. One brand new law was brought in. When I see IBC, when I see IPAC, I say, hey, listen, definitely this expert committee has the possibility of pulling off a made for fit for purpose, bespoke AIF for India, plus foreign funds investing into India with their own unique tag saying this is a foreign VCP investment. I believe it's possible. I am very confident, and the details, of course, are many, but these things give me confidence. SEBI's IPAC as well as the IBC, the manner in which it was rolled out.
Rehan, the post-2010 journey, I think, we were one of the last funds at Bloom which squeaked in fund before DVCF cut over to AIF. And we thought AIF was a much better regime. Our fund one was actually 100% DVCF. And then it brought improvements. But I mean, if you had raised DVCFs, then we would have said, the world's come a long way relative to what was done back then. But Rehan, I know you've been very vocal about what you would love to see. But what has also sort of been positive surprises in that last 8-9 year journey from when you started?
Sure. No, thanks, Karthik. Yes, I think we started just when AIF had been introduced. I think we were one of the earliest AIFs you started under the VCF regime. So I think AIF has been a big positive, shifting over from the VCF regime. But over the years they seem to be tightening it. It was meant to be a very broad, light touch framework, but they seem to be moving away from that, and that has been constant feedback from the industry that hey, you're moving away from this light touch framework, which was the original strategy, to this very monitored, detailed, structured template, which is not a great thought process. So I think that has been universal feedback. I think the other area where we've given universal feedback is around the whole tax system. And let me explain how this tax disparity is suddenly biting a lot of funds. Right. So as we know, 2021 had a lot of IPOs, and 2022 was supposed to have a lot of IPOs, right? And because of the IPOs, a lot of companies went ahead and did bonus issues in order to reduce their share price, right? Now, what has happened is all that stock has gone and become STCG, unlisted, 42% tax, right? So now, if IPOs are going to get pushed back, thanks to Mr. Putin and Mr. Biden and whoever else in the world who are running our portfolios these days, and let's say they go all the way to 2023, because this year might be a wipeout, you're suddenly stuck with this stock, which is STCG, right? Instead of carrying LTCG stock because of this, and at a very high rate, right? 42%. Whereas on the unlisted space, we're driving around 15%, right? So this creates weird problems just because of this kind of disparity.
Got it.
Yeah. So
I'm going to touch on that LTCG parity point right after this, and I'll give Siddharth and you a shot at that. Siddharth, anything to add on sort of regulatory tailwinds that have spurred the industry?
Yeah, sure, happy to. So we've actually started off our journey the latest, in fact, and actually 2016. Yeah. So when we started off, the AF regulations were actually 28 pages. Now they're about 64 odd pages as part of it. The only thing that's actually compounded more quickly than the growth in the AF regulations has actually been the size of the AF industry in itself, and even to the point that Ashley actually made. Given the fact that we're actually given the fact that more regulations come in, for every regulation, there's always an equal and opposite structure that the industry is unfortunately forced to actually end up employing as part of this. So one of the things that we would actually like to actually go back to is a more light touch regulatory framework. Now, the AF product in itself has actually been created for sophisticated investors, and a large amount of it worldwide has always been driven by the primacy of contract. So, depending, so long as all the LPs and the GPs actually align, and this is the way they want the fund to actually operate. These are the sort of leverage metrics they want. This is sort of concentration they want, how they want the IC to function, etc. They should be allowed to actually get into a particular contract and then to actually take that entire thing forward. But what we've actually seen happen over time is that some of these elements have actually ended up getting diluted to some extent, whereas we've actually seen liberalization to some of the other extents that's actually happened. So it's sort of been a zero-sum game where the regulatory burdens more or less remain the same. There have been some improvements in certain regards. There have been they've actually been, they've become more onerous in other regards itself. Lastly, when it comes to tax, I think the tax department has actually done tremendous work in terms of actually reducing the ambiguity when it actually came to capital gains. One of the greatest things they actually did in 2016 when we started off was to actually say that, look, in case you're an investor for that matter, in case you actually do A, B, and C, which are actually objective things, we'll actually classify all your gains as capital gains and we no longer call it as business or profession. That was actually a tax difference for, especially in the listed space, between 10.91% to about 42.7%. That's a massive difference to actually go away to a large extent. It's actually helped the industry to actually start scaling up thereafter as well. So similarly, as we've actually seen this sort of liberalization actually come in, what I hope to actually see later is for us to actually move to a lighter regulatory framework, where basis contract itself, everyone can actually choose how to actually manage their funds. Because given the fact that you're alternative in name as well as in spirit, trying to actually straitjacket everyone into a particular framework in itself will actually end up becoming counterproductive as part of it.
Very, very useful inputs. And to continue that, and I'll go in the reverse order, Siddharth and Rehan, again, advocates of parity, and what does it do? If you can educate the audience on why the industry has been screaming loud for parity on long-term capital gains, or rather even short-term capital gains, all capital gains between listed and unlisted. And then I'll weave it through Gopal in an interesting way, and then take a different question to Ashley. Yeah.
Sure. See, we always said that it creates different incentives, right? Because for early stage investors, they're likely to exit at mid stage or pre-IPO, and they have to pay higher taxes. A lot of founders, ESOP holders, when they cash out, they have to pay higher taxes because the tax rate unlisted is just so much more, double. In fact, it can even be triple when it comes to the case of STCG versus listed STCG, right? Almost triple. So that was what we've always said over the years, that this is a big issue. You are incentivizing the secondary market, which is the listed space, versus incentivizing the primary market. You are incentivizing foreign capital, which is at the lower tax rate, versus incentivizing domestic capital, which is at the much higher tax rate. But now you also have this additional case, right, which is the one I recently put out, that now this case has come to light, that supposing a company goes and does bonus issues prior to IPO, which they have to do to bring their share price down in order to make it palatable for IPO, and then for some force majeure reason, your IPO gets delayed by, let's say, 1 year, 2 years, all the investors are holding stock, which is unlisted stock, and is STCG for the next 24 months, right? Which is suddenly then becomes a big problem because you were holding LTCG stock, hoping to go IPO and sell it, right? So there are all kinds of issues, and maybe more cases will come up because of this disparity, right? Two cases now are known. Who knows what else is sitting? So it is best that we, simplify this and come up with a unified regime.
Siddharth, anything to add?
Adding to that, I think, it's an artificial distortion that's actually been instilled into the tax code right now, where the assets are actually the same, the equity shares, the preference shares for that matter. But for some artificial reason, they've actually been taxed at almost twice the rate. In fact, they'll be taxed at 2.4 times the rate that actually applied thereafter. And most Indian LPs Indian LPs and global LPs are very, very sensitive to the amount of tax they actually have to end up paying in order to make sure they actually get their returns. So when you look at the pre-tax returns, the AIF, the unlisted space at times have actually exceeded the listed space in terms of the returns itself. But the moment the tax actually comes in, the returns actually end up slipping. So the moment that slippage actually happens, it actually pushes a large number of LPs to actually start moving towards the listed space as opposed to the unlisted space itself. And mind you, the listed space actually has a whole host of advantages compared to the unlisted space. There's a large amount of liquidity that exists in the market, so they can actually exit. It's a 1-year holding period versus a 2-year holding period. And despite the fact that all the money that goes into the unlisted space is primary direct investments into these companies and into new asset creation, the fact that they're actually being penalized by almost to 100% tax increase compared to the listed space actually becomes extremely counterproductive. That's why the industry has actually been screaming, because this is essentially a glass ceiling that's been placed upon the industry. And the AF industry in the country has actually grown at a CAGR of about 108% from December 2012 all the way to December 31st, 2021. The moment that tax arbitrage actually went away, or actually goes away, the entire industry can actually end up blooming and actually blossoming thereafter. And this in turn is actually depriving Indian fund managers of this entire asset class, where we're seeing a number of, because for tax reasons itself, a number of Indian entrepreneurs are choosing to actually domicile their businesses overseas, and they're choosing to actually become NRIs in order to target the Indian market, all because of the reason for tax. So that's one of the easiest things to actually solve, and actually becomes a leverage that ends up getting created in the industry thereafter, which is why everyone on this call has been passionately speaking about the tax piece for a very long period of time. And parity needs to come in, whether it's parity downwards or parity upwards. The moment the parity actually comes into the entire place and tax is knocked out of the equation, then market forces can actually start commanding it thereafter, and the fund manager will actually be this one. His merits in terms of stock selection actually comes to the forefront.
No, I think so. Two sort of takeaways. One, I think the big one is, I think, the recognition that primary capital formation is dramatically more interesting if you want to fuel this 25-year journey, right? You can keep throwing as much trading, or holding or investing capital into the secondary markets, but it doesn't go into the businesses at all, right? And business formation, fueling entrepreneurship is the only hope we have to, double, triple the economy. And that is almost entirely fueled by, this industry. And yeah, I mean, and Shark Tank maybe, but my point is like, this is angels and this industry is what's going to fuel that. But then that penalty is very expensive, especially when that kind of primary capital formation, the bulk of it for the first 2, 3, 4 years of every one of these startup journeys is actually predominantly going into talent training, boosting their incomes, boosting the average, the average Indian, and therefore finding its way back in income tax dollars to the government any which way, right? And so that's the sweet irony of, how primary capital is kind of, sort of, double penalized in some sense. Second is, which is where I wanted to cut over to Gopal, how it's remarkable, as you said, Gopal, that you're able to raise 100% Indian fund in thousands of crores today, right? As you said, I would have thought it impossible. We also had a very similar start. People usually fall off the chair that we raised an early stage seed fund in India, 2011, 100% domestic, right? So what they don't, the subtext is, I had to pitch 600 people to get 75 to say yes. Right? And so people said, what the hell are you talking about? Like, why should I play this asset? Highly risky, everything Siddharth said. Highly risky, illiquid. You actually walk into the room and tell me you can lose bets. Which investment manager says he loses money on a few bets, right? And so we said that's the nature of the game. And so people were paranoid, but we've come a long way in 12 years. And so why is this? I'm weaving the tax thing to saying, how are you able to convince more and more domestic capital to come in? All of us are in our own way, but you're unique in the sense that you're 100% domestic. And maybe the right place to also weave in, what does this mean in terms of bringing large Indian financial institutions of all kinds or family offices to a higher level of education to come and participate in this growth paradigm that the industry is setting, right? Of course, a lot of them are trying to do it themselves. Like, the amount of family office investing directly and sub funds has just been fascinating to watch over the last 3-4 years. What are your thoughts, Gopal, on a couple of these points?
You know, Karthik, this is a great panel, and I'm hearing some, I'm just loving many of the things, the nuancing that's going on of the points, right? Of the points that we always knew, but it's getting nuanced. I think two, three things, One is that I think we have a kind of, to use a very cliched expression, we need a barbell approach, which is a kind of standard answer now to everything. So one side is fundamentally we need to let the institutional capital in, which I think the government's approach of this blended finance, 2080 formula, creating more and more fund of funds, which initially may be needed. Long term, they may not be needed in 10-year time. But initially, I think you need that kind of training wheels of a fund of funds, where 20-30% can come from NPS, from EPFO, from charitable endowments. And then can be a set of very well recognized gatekeepers, whether they be wealth managers, mutual fund managers, foreign fund of managers, or even the Indian institutions like SIDBI and IF. So that is one way to encourage. Now the laws have been passed. NPS can invest in AIF 1 and 2. EPFO can invest in private PPFO, can invest in 1 and 2. So that we need to create that culture. I think that is one key part of the institutional side. I think it's ready. We're at the tipping point. It kind of needs to be pushed over right now. And I think the blended finance model, which is the word they're using from developmental finance, that expression they borrowed to create the fund of funds, is one very important way. But equally, I think, Karthik, we need to have a different approach. I think we need to democratize fundraising on the other hand. Why is it I cannot go to digitally and say I want to put 25 lakhs into Bloom or 50 lakhs into Bloom? I think we need to get out of the Western model where it's a kind of bilateral arrangement between large institutions. So we need to create mechanisms, which means a lot of governance mechanisms, right? A lot of transparency. How do I get comfort? It's like an IPO, right? And you're giving retail investors the right to put direct money in. So we need to democratize as much, because I think that blended finance may allow that. I recall Gopal Jain commenting recently in a IVCA call last week. Why can't we allow 10 lakh checks for fund of funds? Because there are known gatekeepers and there is risk diversification across multiple funds who in turn have portfolios. So I think we need to do both, because I think we need to attract also the retail investor money is one thing. And I hope that this kind of expert committee can apply its mind on these kind of frameworks as well as it can apply. So the world is moving towards permanent capital. So we also need to think, I think, differently about the public money who like this kind of permanent capital also eventually. So I think we have a roadmap to how do we get to permanent capital? How do we get to institutional money into the funds through a blended finance program? And how do we also keep the door open for retail? Why is it because the world is so different. All what happened in America is based on 80s and 90s experience. Right now, we are forming our views based on 20s experience. We have a chance to do things differently. And as C.K. Pranad always say, establish the next practice. So I'm actually optimistic that India will take a slightly different road, not the proverbial road less traveled, where actually the author never went on, but really go on to the road less traveled and find these new ways of doing things like, retail finance, getting the blended finance as an interim mechanism to get the government money into the funds, and ultimately think about permanent capital. I think it's so important when you hear about companies like Sequoia and Westbridge, in some sense, who innovated permanent capital even before Sequoia, and of course, Prem Vatsa. A lot of lessons to be learned from them. So I think we should think for those next practice ideas, as well as give safe passage of government money into funds.
Yeah. No, it's interesting because, today, the startups that we fund, not all of them, but a bunch of them, actually allow for this kind of risk-taking more than the financial institutions, that is us, are allowed to take. So the startups that we fund are allowed to take this in terms of, pooling credit risk and creating a sort of financing mechanism to pool credit capital to be able to lend to small folks. Similarly, to be able to sort of crowdfund and raise equity for that matter. So, there are platforms which are probably ahead of us because we are stifled by or regulated or restricted by one set of regulations. And I think you're absolutely right. I think Indian capital is generally a little worried about the fact that illiquidity is a big issue. Exits are a big issue, just as global LPs are. But the minute you come up with creative mechanisms to think of listing doing, as you said, public offerings, or even at the least start with actually having the ability to, under a certain set of disclosures, take the institutional trading platform and put your units out there for others to buy. This automatically, there's more, when somebody sees a 5-year term to maturity, there's a lot more demand for that asset. And we've realized that, and I'm sure some of my peers in like Siddharth and Rehan, we've done
when I see people like Ashley, I see that Chris Cap is trying to invest in companies that will be the next 20, 40, Nifty 50, So they need that kind of capital, that kind length of capital.
Yeah, absolutely. No, and I think, the idea of building that kind of permanency in capital is a great idea. So bringing that to Ashley. So Ashley, you're one of the few funds here, at least on this panel, which is, I think, predominantly, if not 100%, foreign LP money, right? One is, what have their primary concerns been around India? What has shifted in our favor? And what is the outlook that you see for this next decade, let's say? Because our business has to think in decades, right? So what do you see as the primary drivers out there? I would love to get a sense of what you're hearing from the LPs, and do you sense a move with someone who's established? You're the oldest fund house here, 22 years. Are they telling you to think through your strategy to move to permanent capital because now you're an established institution that can outlast each of your current founders and your early partners? Right?
Yeah, no, I think it's a very interesting question, Karthik. Look, I think LPs are LPs. I think you'll have nuances of views or differences in terms of how they think about it, whether they're foreign LPs or domestic LPs. I think most of the investors that are overseas investors have been investing in this asset class for a long period of time. And so, some of the aspects of liquidity, managing liquidity, or, looking at it from a 10, 12-year lockup period, I think those demons are behind them to a large extent, right? So they don't have those concerns to say that, look, we need liquidity in 6 years or 5 years to churn it, because they've been doing it for 30, 40, 50, some, over much longer as well. And so they don't have those concerns. That being said, I think India does get bracketed for foreign investors. Right? There are multiple ways to do it. One is it's US and non-US. In non-US, it's emerging markets versus non-emerging markets. In emerging markets, again, then you could get bucketed into Asia, which doesn't happen too often now, but has been happening. And then there's India. So then people then look at it and say, what is the exposure they need to have? So investors, the de-risking or the deconcentration models that they have could negatively affect you as a fund house. As you're looking to raise capital, you're automatically bucketed into saying, someone says, look, we want to invest in the US because it seems attractive. And we had that phenomena, 2-3 years ago. So you were not competing on your track record. You weren't competing on what you were doing, but you were competing on what other opportunities were available for investors. And that is fundamentally the reason why, I believe, to your second question, I think India needs to evolve as an industry to be less dependent on foreign capital. We need to be focused on having, Indian investors in. We've tried it as a country. We've tried it, for some time. People like Gopal has been very, very successful. You guys have been also, all of you guys have done that very well. I think I remember the early days when initially the target was focused on institutional capitals in India. And I think there were a few checks written. The experience was not overall great for those domestic investors, and you saw them becoming a lot more shy. What has happened over the last 5-8 years or so is the family offices has emerged as a very large way to fill in that gap. And that is also predominantly because of the fact that the people have made money, either through investors or through other routes. And so you're seeing that money come back. That being said, Gopal is obviously very, very innovative, and I love listening to Gopal all the time, right, on these thought processes. I think the whole idea of using the fund of funds as a way to even encourage retail money, and I think is a fantastic solution, right? Because one of the things, as Sid was saying, and one of the things that today regulators think about funds is that they don't understand the fact that today we have sophisticated investors, and we are tom-tomming the fact that we have sophisticated investors who write large checks and understand our business, and therefore we don't need to be treated like a mutual fund in terms of lots of check and balance regulations. But the fact of the matter is, while we do have that and we do want that for us, is there a way that a retail investor can play that? And the route may be the fund route, where you have a different category of funds that helps investors participate in the overall private equity universe. And that set of funds requires more oversight, more regulation, because you're dealing with retail money as opposed to more sophisticated investors. So it's great to have an opportunity to do something like that. So I think that those kind of solutions are what we would want from a longer term perspective. In my mind today, 85% of the money comes from foreign sources, 80 to 85%. Can we change that to as opposed to 85-15? Can we change it to 15-15, or at least 25-75 over the next 10 years? I think that should be the endeavor for the country as a whole, and I'm hoping that this expert committee can help think through ways to do that. And people like Gopal, getting innovative solutions. I think those are things where we need people to be open and receptive to sort of listening to these ideas, thinking from a 10-20 year time horizon.
Thanks a lot. We're down to the last 7-8 minutes. I'd love for all of you to think through, maybe one or two, sort of dreamy ideas, right? So beyond the expert committee, right? So someone asked on the Q&A, what are the changes that your panel would like for the EC to consider? And Gopal already replied to this, and this is a fact at Kinshuk who asked the question, that we've been presenting these issues. The list has grown longer and longer. It was in the 20s, now in the 30s, now it's reached 45. Basically, the IBC has always invited members to give points that maybe the committees have not thought through, right? And therefore the list keeps growing. So the idea of the expert committee was to ensure that every point of view from the industry, early stage, late stage, VC, private equity, global funds, domestic funds, real estate funds, Cat 3, Cat 2, Cat 1. Make sure that everyone's heard, and you have the expert. If you're getting this one expert committee, in which we had, then let's not waste that on trying to iterate it over multiple years. Let's go as comprehensive as possible. And Gopal here has always used in every conversation that I've been a part of along with him, the fact that if you could do this for a bankruptcy code, then why wouldn't you do it for fundamentally what could be one of the most game-changing forces for India's economic growth, right? Which is private equity venture capital for this country. So that I think kind of summarizes all of the takeaways from the panel. What I'd love to hear is just super futuristic ideas to make it a little bit more fun. I think we've covered almost everything we wanted to. If I've missed out anything, or if you missed out saying anything, please do add. But maybe go in one round with all of my 4 panelists and get to hear what would they like to see in 2030, or as each one of us is retiring from an industry perspective. Of course, we would all like India to be a $7-10 trillion economy sooner than later. But what would we like to see from an industry perspective? If Sid is probably going to be running this thing the longest. Going by airlines and age. Yeah, but
one of the things that I would genuinely like to actually see is the conversation actually shift from how do we get more foreign capital into India to how do we actually start getting Indian capital to actually start going overseas. Now, India as a country is not as much of a capital deficit country as what people have actually let out to believe. We've actually had a whole host of regulations and a patchwork of regulations that actually prevent us from actually exporting rupees overseas and from actually investing overseas thereafter. And geographical diversification becomes very, very important for any country that's actually growing from becoming a developing country to a developed country as part of that. And mind you, if you look at any of the fund manager, any of the fund houses globally itself, you'll always actually end up finding one Indian fund manager over there. Be the largest ones in New York, Singapore, Luxembourg, London, or anything for that matter, there's always Indian minds that actually power a large amount of this. So the moment we actually shift the conversation to having Indian funds actually being able to invest overseas as part of it, without having to go through regulatory approvals, without having to actually prove some sort of substance and everything as part of it, but driven purely by an economic decision, that in turn will actually really empower the Indian fund management industry and actually end up supercharging us to a very, very large extent. Because this in turn will actually allow Indian LPs, be them financial institutions, family offices, etc., to actually get the sort of geographical diversification, and in turn will also greatly augment India's forex reserves as well. Because the moment money actually goes out and when the money comes back in, it's always a multiple on the cash that's actually gone out as part of it. And when you look at the average returns of the entire AF industry, the median returns are close to about a 30% IRR as part of it. If you could actually start contributing some amount of that to India's large forex reserves, we'll actually end up compounding that also very, very aggressively. So that's something I would actually love to see happen in terms of our regulations and this sort of moonshot idea.
So we're already seeing the Gen X, Gen Z views of the country, Gopal. Why don't you go next? And then I'll ask.
No, actually, I was going to say the same thing. Was to say that I want India to be a fund management hub for the world. Whether we manage foreign money or Indian money, to me, is the next level of question. But I just think we must be like our IT industry, like people like Sid's dad and Infosys emerged, that we should be exporting fund management talent through an institutional platform. So Sequoia and Lightspeed and all the others can be in India. I would love to see 314 and Orias and certainly ChrisCap and obviously Bloom actually having presence in, maybe when Africa opens up, you will be the guys who the go-to guys in Africa and say, hey, listen, I got a term sheet from Bloom. It was a wild celebration. Right? And when Africa publishes its league tables, Indian fund managers are right on top. I mean, whatever be the money, they could be managing even their own country's money, plus Indian money, plus dollar money, right? So I just think IT story replicate, India leads the world. To me, as Sid said, the talent is anyway, they have to suck them into our platform. But I want the Indian GPs to dominate the world.
Ashley, Rehan?
They're already in Africa.
I think Sid and Gopal have touched on the key thing, and how do you globalize this business? And I think that's extremely important. So I won't touch upon that. I think that in my mind, that's also the one thing that I would want to see in 10 years, and that's a top thing. I think the other thing is just, specifically, I think, how do you make it a more conducive environment for investors to be in, right? So whether it's establishing, replicating the GIFT City model, whether it is replicating, some other models that have got the fund-to-fund sort of models, the blended fund models. I think those are things that I would like to see, at least over the next 5-7 years. Right? I think, and I think those, in my mind, would be things that would bring the impetus to bring about the fund management, export of fund management business as Gopal very.
And Rehan? The final word on this.
Sure. Whenever I go overseas, it just strikes me how expensive things are, right? And when I come back to India, I notice how reasonable things are, right? So starkly on those trips. And I think what I would like to see 10 years from now is the growth of Indian capital. Right now we have it in the early stage ecosystem. I would like to see it more in the mid and the late stage ecosystem, so that more India for India models, which are frugal innovation based models, are recognized and they are funded, because that is something unique that we offer the world. This frugal innovation, right? Right now, most of our models are models, because they're based on international capital, they've got skewed in a particular direction. And all this 10-minute grocery delivery and all these are luxury models, right? Which are coming around in this country. And they're coming because of this large amount of international capital. Those guys see it in their country and they say, okay, let's go do it in India. But the growth of the domestic industry for me is not just as a source of capital or as a source of some kind of self-reliance, but it's also for the growth of this unique thing that India has to offer the world, which is frugal innovation. So that is what I would like to see 10 years from now, a lot of frugal innovation emerging because of the emergence of our domestic capital industry.
Well put, Rehan. I think the micro VC industry in India, not taking away from my other panelists, is a great example of how much we've done with how little. So on that note, I thank all my lovely panelists here. Looking forward to working with a lot of you in the coming year in various committees and pushing the various demands that we've made of the government for the industry, not I know these are carefully chosen words, but not demands for the sake of asking for freebies, but actually evolving the market, the regulations, the industry, so that we are change sort of agents in this economy to be able to deliver the promise that India is able to. And we sense that every day in the entrepreneurs we meet, but you need a lot more capital, a lot more managers, a lot more sort of fluidity in the system to be able to accelerate that. And the only hope to do that, to move masses of hundreds of millions of Indians into that next level, is this velocity. Otherwise, you lose generations at a time. And that to me has been the most stunning part of watching some of these startups grow. And we all collectively hope that we get all the the pace setting for the next 2.5 decades. So here's to that thought. And once again, thank you everyone. Thanks to IVCA for giving us this panel.
Thank you, Karthik. Thanks all.
Thank you.
Thank you. Thank you. Bye. Bye, everybody.
Are we done? Exit?